Welcome back to the deep dive. Today, I want you to imagine a scenario. It's January 2026. You're standing in the middle of a massive data center, one of those nondescript, fortress-like buildings in Northern Virginia or the Oregon desert that basically run the modern world.
The places where the internet actually lives.
Exactly.
Got
And
it.
it is loud. The hum of cooling fans is just deafening. You're looking at a single server rack that costs, say, $3 million to build. It is packed with the latest, greatest AI chips. And suddenly, a single red light blinks. One chip fails.
And that right there, that is the nightmare scenario for these companies.
Right, because in 2026, we're not just talking about a computer crashing anymore. We're talking about a failure in a neural network that might be, driving a car or managing a power grid or diagnosing a patient. The stakes in the semiconductor industry have. They've fundamentally shifted. For the last decade, the game was just speed. How fast can we make the chip?
Speed and size, that was the whole game. It was Moore's law, smaller, faster, cheaper. That was the mantra for, what, 30, 40 years?
But today, and this is specifically because of the explosion of artificial intelligence,
Yeah.
the game has changed. It's no longer just about speed, it's about certainty. It's about making sure these incredibly expensive, incredibly complex brains of the future don't melt down 3 weeks after they're installed.
It is a really subtle shift in language, but it's a massive shift economically. We've moved from a world of consumer electronics where, if your phone glitches, it's annoying, but life goes on to a world of critical AI infrastructure.
Right.
When a single NVIDIA chip or a custom-built AI chip costs as much as a mid-sized sedan, I mean, we're talking literally $30,000 or $40,000 for one device failure is not an option. It becomes an economic catastrophe.
And that brings us to the subject of our deep dive today. We're looking at companies called Aehr Test Systems. The ticker is AEHR. And frankly, this company is standing at one of the most fascinating and precarious crossroads I've seen in a long, long time.
It really is the perfect storm of conflicting trends. You've got these massive secular waves crashing into each other.
On one side, you have the electric vehicle revolution. Or maybe we should start calling it the stalled electric vehicle revolution, because that market has cooled off in a big way over the last year. And that was supposed to be Aehr's golden ticket.
Right. That was the thesis. That was the story everyone bought into back in 2024.
But on the other side, you have this absolutely exploding AI boom. And Aehr is trying to navigate this transition between the two. They are trying to pivot a moving ship in the middle of a hurricane.
It's a classic pivot story, but what makes this one so interesting is the specific job to be done that Aehr performs. I mean, they're a tiny company, relatively speaking, but they sit at a critical choke point in the global supply chain.
Let's use the analogy that really stuck out to me from the research, because I think people hear semiconductor equipment and their eyes just, glaze over.
Yeah.
But Aehr, they don't actually make the chips.
No, not at all. They don't touch the design process.
They don't design the logic. They don't build the software. They effectively sell the insurance policy.
That is the perfect way to frame it.
Yeah.
Absolutely perfect.
They provide the technology, specifically something called burn-in testing, that prevents that $30,000 AI chip from failing 3 weeks after it gets installed inside that massive server rack we were just talking about.
You're buying certainty. And in a world where data center uptime is maybe the most valuable currency on the planet, that certainty commands a massive, massive premium. If you're Microsoft or you're Amazon, you will pay almost anything to ensure that chip doesn't die on you.
But, and there's always a but on this show, despite the hype around AI and despite the fact that Aehr is positioning itself right in the center of this storm, the numbers, well, the numbers suggest we need to be very, very careful.
Caution is definitely the word of the day here. It's easy to get swept up in the narrative.
The sources we've pulled together for this deep dive suggest that the smart money is actually waiting.
Yeah.
They love the tech, they love the story, but they hate the price.
And that's the tension we're going to explore today. Great technology does not always equal a great stock buy at any price. We have to look at the valuation, we have to look at the execution risks and the cold, hard reality of the market.
So here's our roadmap for the next hour. We're going to look at this massive pivot they're undertaking from EVs to AI. We're going to get into the weeds of the specific technology because it's actually really cool physics involving liquid cooling and thermal runaway.
It is fascinating stuff.
We have to talk about the EV winter that absolutely crushed their revenue recently.
Yeah.
And finally, we're going to run the numbers, the valuation, to see what this company is actually worth.
Sounds like a plan. Let's do it.
Part 1. Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
So let's unpack exactly what Aehr does. I think most people, when they hear chip testing, they have a very simple image in their head. They probably imagine a machine at the end of a conveyor belt that just sort of plugs the chip in and checks if the lights turn on.
Right. Like checking a light bulb at the hardware store before you buy it.
Right.
Does it work? Yes. Okay, good.
Exactly. And to be fair, that type of testing exists. That is what the industry calls functional testing.
Functional testing.
And there are huge companies, giants like Teradyne or Advantest, that dominate that space. Functional testing is basically asking the chip, do you work right now? Is 2 plus 2 equaling 4? Are you processing logic correctly at this very second? If the answer is yes, it passes. It goes in the box.
What, you're saying that's not enough anymore?
It's not that it's not enough. It's that functional testing has a fundamental blind spot. It cannot predict the future. It tells you the chip works at this exact second. It doesn't tell you if the chip has a hidden defect that's going to cause it to die next week.
And that's where burn-in comes in. This is Aehr's entire world.
Exactly. Burn-in answers a completely different and, frankly, more important question for critical applications. Will you still be working in 3 months? Will you survive the stress of the real world?
Why is this such a big deal? I mean, if I buy a toaster and it breaks in 3 months, I just take it back to the store. It's annoying, but so what? Why is it so different for a silicon chip?
It comes down to a really important concept called infant mortality.
That sounds dramatic.
It is a term of art in silicon manufacturing, and it's a huge problem. When you manufacture these unbelievably complex devices, especially with new materials or complex packaging, there are always microscopic defects. Maybe a layer of copper is a few atoms too thin. Maybe there's a tiny impurity in the silicon lattice.
Things you can't see with the naked eye.
Things you can't even see with a standard microscope sometimes. Now, these defects, they might not show up immediately. The chip might pass the functional test with flying colors, but if you stress the chip, if you heat it up, run high voltage through it, really push it to its absolute limit, those weak points will fail. They'll snap.
So the chip dies.
The chip dies. And the entire philosophy of burn-in is this. You want the chip to die in the factory, not in the customer's device. You want it to die in your oven, where it costs you a few $100s to toss it, rather than in the field where the costs are astronomical.
Because if it dies in the field.
Well, historically, if it died in the field, it was just an annoyance. Maybe your digital watch stopped working or your first-gen MP3 player died. So for a long, long time, burn-in was a really niche thing. You only did it for chips going into, say, missiles or satellites or maybe a pacemaker.
Life and death applications.
Exactly. Things where failure was not an option. You would never do it for a toaster chip. It was too expensive. Not worth the effort.
But the world has changed.
The world has totally changed. Now, look at the AI ecosystem. If you are a hyperscaler, and by that we mean the giants, the Microsofts, Amazons, Googles, Metas of the world, you are building these colossal data centers with thousands of H100 GPUs all clustered together.
And these clusters are designed to work as one giant cohesive brain. Right?
Precisely. They are all interconnected. If one chip fails, it doesn't just take itself out. It can disrupt the training of an entire model. It can corrupt data. You have to send a technician out to a remote aisle, pull out a server blade, diagnose the problem, replace the chip. The downtime, the labor, the disruption to your cloud customers. It's a complete nightmare.
So suddenly, burn-in isn't just for missiles and pacemakers anymore. It's an economic necessity for the entire internet infrastructure.
It's table stakes. Reliability has become a premium feature that customers will pay for.
So Aehr provides the systems, basically giant, high-tech ovens that perform this stress testing. But here is the major twist in the story. They've had to shift gears violently in the last year or so. Until 2025, the story wasn't about AI at all. It was all about electric vehicles.
That was the old thesis, 100%. If you looked at Aehr 2 years ago, they were heavily, heavily tethered to silicon carbide.
Silicon carbide, okay, we hear that term a lot. These are the special chips used in EV inverters to manage power from the battery, right?
Correct. Silicon carbide is amazing stuff. It handles high voltage and high temperatures much better than normal silicon. It's what makes your EV charge faster and drive further on a single charge. But it is notoriously difficult to manufacture. It's very defect-prone. It has a high instant mortality rate.
Which sounds like the perfect use case for Aehr's technology.
It was. It was a match made in heaven. It required 100% burn-in. Every single 6 chip had to be tested. Aehr rode that wave and secured huge wins with customers like ON Semiconductor. The stock went on an absolute tear.
But then 2025 hit, And the sources we've looked at describe it as the EV winter.
It was a brutal year for the entire sector. Think about what happened macroeconomically. You had interest rates skyrocket, which made financing a new car much more expensive.
So,
Suddenly, people weren't buying new Teslas or Ford Mach-Es at the same rate.
and the government subsidies were drying up too, weren't they?
They were. Germany cut its subsidies. The U.S. changed the rules for tax credits. And then, on top of all that, you had this flood of very affordable, very good Chinese EV exports starting to disrupt the global market. The major automakers panicked.
They slammed on the brakes.
They slammed on the brakes, they pulled back on their electrification targets, they paused construction on new factories.
And if they stopped building factories?
They stopped buying test equipment. It's a classic bullwhip effect that flows downhill, and Aehr was right at the bottom of that hill. Their revenue didn't just dip, it fell off a cliff. We're talking a drop of 27% in the second quarter of fiscal 2026 because of this.
That is a massive hit for a small company. I mean, imagine losing a quarter of your paycheck overnight.
It caused a lot of panic among investors, and rightly so. But this is where the pivot comes in, and you really have to give management credit here. They didn't just sit there and wait for the car market to magically recover.
They shifted the entire strategic focus of the company.
They shifted to what they call packaged part burn-in for AI processors. This became the new mantra.
And this brings us to the new thesis, the AI thesis. What was the specific turning point? What was the event that signaled this shift?
The big catalyst was an announcement on January 8th, 2026. Aehr put out a press release saying they had received $5.5 million in orders from a lead production AI customer.
Now, they didn't name the customer. They never do. It's always a large Fortune 500 company or something equally vague. But the rumors are flying.
The industry speculation is very, very strong that it's a hyperscaler. We are likely talking about a company like Amazon, Microsoft, or Google that is designing its own custom AI chips.
Why is that distinction important, the part about them designing their own chips?
Because the big guys are getting tired of paying NVIDIA's massive margins. They want to control their own destiny, optimize silicon for their specific workloads. So they're all building their own custom chips. Amazon has Trainium, Google has its TPUs. And these companies are absolutely obsessed with reliability and uptime. This order was a huge validation that Aehr's technology works for this new, incredibly important class of chips.
Okay, but I want to get into the how for a second.
Yeah.
Because I'm still a bit skeptical. Why can't they just use the same ovens they were using for the car chips?
Right.
Or the ovens that have been around for 20 years? What is the specific, unique problem with these AI chips?
It comes down to one word: heat.
Heat.
Modern AI chips are absolute beasts. I mean, we are not talking about the chip in your laptop. We're talking about power consumption in the range of 1,000 to even 2,000 watts per chip.
I need a comparison. Give me a real-world example of what 1,500 watts feels like.
Okay, think about a standard space heater, the kind you put under your desk in the winter that, trips the circuit breaker if you plug in a hairdryer at the same time. That little heater is running at about 1,500 watts.
Oh, okay, so that little box that gets scorching hot to the touch.
Now imagine compressing all of that heat, all of that energy, into a tiny square of silicon the size of a drink coaster.
That is intense.
It is incredibly intense. The energy density is completely off the charts. Now, remember, the whole goal of burn-in is to stress the chip.
Yeah.
That means you have to turn it on and make it work hard.
Right. You can't test it when it's off.
If you put that 2,000-watt AI chip in a traditional air-cooled oven, even a really fancy, expensive one, and you turned it on, the air simply cannot move the heat away fast enough. It's a matter of physics.
It's like trying to cool a nuclear reactor with a desk fan.
That's a perfect analogy. The chip would go into what's called thermal runaway almost instantly. It would get hot, which makes it draw more power, which makes it get even hotter, and within seconds, it would literally melt or destroy itself. You would destroy the very thing you are trying to test.
So you can't use air? What does air use? What's the solution?
Aehr's solution, specifically their FOX-XP and their new Sonoma systems, uses direct contact liquid cooling.
Like radiator fluid in a car.
Similar concept, but way more sophisticated. It's not just about plunging the chip in a bucket of water. They have a proprietary technology called active thermal control.
Okay, how does that work?
Imagine you have a tray loaded with 18 full wafers or thousands of individual loose chips. The system has sensors that monitor the temperature of every single device individually in real time.
Individually. So if chip number 405 over here is running a little hot, but chip number 406 is running cool.
The system reacts instantly. If a chip starts running too hot, the the system actively pulls more heat away from that specific spot. It might increase the coolant flow or adjust the contact pressure. If a chip runs too cool, it lets it heat up. It dynamically maintains a perfect, stable thermal environment for thousands of chips simultaneously.
That sounds incredibly complex to engineer.
It is. It's a huge engineering challenge. And that difficulty, that complexity is what creates their competitive moat. Because once you solve that thermal problem for a customer, you effectively lock them in.
And that leads us directly to the business model, which I know you love, the classic razor and blade model.
It is the holy grail of hardware sales. You know the model. Sell the printer at a low margin, but make all the money on the ink cartridges. In Aehr's case, the printer is the Fox system, the big, expensive machine. But to actually connect the machine to the customer's chips, you need something called wafer packs or die packs.
Describe those for me. What are they?
These are incredibly complex, custom-engineered contactors. Think of a plate that has thousands of microscopic probes like hair-thin needles that have to align perfectly and touch the chip's contact pads without damaging them.
And I assume you can't just use an NVIDIA wafer pack to test an AMD chip or a Google TPU?
No way. It's not a one-size-fits-all solution. Each wafer pack is custom designed for a specific chip architecture. So here's the lock-in. Once a customer like Amazon validates their entire manufacturing and reliability flow on Aehr's system using their custom wafer pack, they have to keep buying those custom consumables.
And what if they wanted to switch to a competitor? Let's say Teradyne comes along with a cheaper machine.
They would have to scrap millions of dollars worth of wafer packs they already own. But more importantly, and this is the real switching cost, they would have to requalify their entire reliability process from scratch. That takes months, it takes teams of engineers, it takes endless data validation.
Nobody wants to do that. It's too risky.
The switching costs are incredibly high. And here's the kicker for the recurring revenue part of the story. AI chips have very short life cycles. They're constantly being updated. NVIDIA's H100 becomes the H200, which becomes Blackwell. Every time there is a new chip design, the customer has to buy brand new, custom-designed wafer packs.
So it's basically a subscription model hidden inside a hardware business.
In a way, yes. In Q2 2026, these consumables made up 35% of their total revenue. As the AI business ramps up, that creates a steady, high-margin stream of cash that helps smooth out the lumpiness of selling the big, multi-million-dollar machines. It makes the business much more predictable over time.
Chapter 2. Management evaluation.
Okay, so the tech is cool, the pivot seems logical, but a ship is only as good as its captain. Let's talk about the people running the show. The CEO is Gain Erickson. He's been there since 2012. What's his vibe? What's the read on him?
Gain is a character. I think that's the best way to put it. If you ever listen to their earnings calls, and I'd recommend you do, they're really quite entertaining. He is definitely what I would call a promoter CEO.
Meaning, what does that entail?
He's highly technical. He clearly loves the engineering. He'll spend 20 minutes on a call explaining the physics of a contactor or the nuances of thermal dynamics. He's incredibly enthusiastic. But that enthusiasm can be a double-edged sword.
Oh, so?
Well, he has been accused in the past of being overly optimistic. He tends to see the hockey stick growth curve as being just around the corner. For example, he was extremely bullish on the EV market right up until the moment it collapsed.
So he didn't see the winter coming.
To be fair, not many people did. The speed of the downturn was surprising. But his optimism can sometimes get ahead of reality. However, you absolutely have to give him credit for how he handled the crisis when it hit in 2025.
We're talking about the pivot again. This was his move.
Yes. When the EV market hit that wall, he didn't hide. He didn't just blame the economy and wait for things to get better. He acted. The single most critical move he made was the acquisition of a small company called Inkle Technology.
Who were they? What did they do?
They were a smaller player in the testing space, but they had a very specific, very important piece of the puzzle. Remember we talked about that 2,000-watt power threshold for the new AI chips?
Yeah, the space heater problem.
Right. Aehr's existing systems needed higher power handling capabilities to really compete for that next-generation AI business. Inkle had that specific technology.
So he went out and bought the missing link.
Exactly. It was a strategic, targeted acquisition. But by buying Inkle, Erickson secured the tech stack he needed to build the new Sonoma platform. Without that move, this entire AI pivot would just be marketing fluff. He bought the actual capability to deliver on the promise.
And I noticed he was pretty transparent about the bad numbers, too, on the earnings call.
He was. In the Q2 2026 earnings report, he came right out and admitted the softness in the automotive market. He didn't try to spin it or hide it. But then And this is classic game. He stuck his neck out again. He made a huge promise.
What did he do?
He reinstated guidance for the second half of the fiscal year. He is projecting between $60 million and $80 million in new bookings.
Wait a second, hold on. They just reported a quarter with $9.9 million in revenue, and he's now projecting $60 to $80 million in bookings for the next 6 months?
That is a bold, bold call.
That is an incredibly aggressive call. It's a huge leap of faith.
It implies he has very high visibility into these new orders from the AI customers. He is basically betting his entire credibility on this AI ramp happening right now in the first half of calendar 2026. If he misses this number, the market will absolutely crucify the stock.
Let's look at how they manage the money. We talk a lot about fortress balance sheets on this show. Does Aehr qualify for that title?
They absolutely do. This is one of the most attractive parts of the company from a safety and risk perspective. They have zero long-term debt, none whatsoever.
I love hearing that. In a cyclical industry, debt is a killer.
It is. And on top of that, they're sitting on a pile of $31 million in cash.
That is huge for a company of this size. It means the bankers can't come knocking and shut them down if they have a bad year or two. It gives them real staying power.
Precisely. It gives them the ability to weather the storm. However, there was a controversial move they made recently that we need to discuss. In the second quarter, they raised about $10 million through an at-the-market offering, or ATM.
Can you explain at the market for the listeners? What does that mean?
Basically, it means they sold new shares of the company directly into the open stock market at whatever the current price was that day.
Which dilutes existing shareholders. Your slice of the pie gets smaller.
Exactly. It slices the pizza into more pieces. Usually, investors hate that. And the first question they ask is, why do you need to raise cash if you already have $31 million sitting in the bank?
Yeah, that's a good question. Why did they do it?
Ericsson's argument is that it was for working capital. If they are truly about to land $80 million in new orders, they need to buy parts and materials now to build those machines. They have to pay their suppliers long before they get paid by the end customer.
So it's dry powder to fund the ramp up.
Exactly.
Yeah.
So while the dilution is painful in the short term, strategically, it was likely a prudent defensive measure. It ensures they can actually execute on this massive ramp without going into debt or running out of cash halfway through the build process.
Now, here is where it gets really interesting and maybe a little concerning. We have to look at insider activity. Do the people running the company, the people with the most information, actually believe in this story?
Well, broadly speaking, the answer seems to be yes. Insiders collectively own about 12.6% of the company. That's a healthy number. It shows alignment of interests. If the stock crashes, they lose a lot of money too.
But I feel a but coming on.
But there was one specific transaction that really stands out and raises a yellow flag. On January 22, 2026, a director named Laura Oliphant sold 3,100 shares of her stock.
Is that a lot? It doesn't sound like a huge number.
In absolute terms, no. But for her, is about 13.5% of her total holdings. And more importantly, she sold them at a price of around $31.40 per share.
Why does the timing and price matter so much?
Context is everything here.
Yeah.
Think about the narrative. The CEO is on the earnings call telling the world that they are on the verge of a massive AI breakout. The stock is supposedly about to go to the moon. The future has never been brighter.
Right. It's the hockey stick moment.
So why would a key insider, a member of the board, sell a huge chunk of her personal shares right before the party is supposed to start?
It makes you wonder. It's not a great look.
It strongly suggests that at least one person in the boardroom looked at the stock price of over $31 and thought, you know what? This is a pretty good price. I'm going to take some chips off the table. It signals that perhaps the stock was fully valued or even overvalued at that level. There's definitely a red flag that directly counters this super bullish narrative coming from the CEO. Chapter 3, Financial Health.
We've talked about the tech and the people. Now we have to face the music. We need to look at the cold, hard numbers for Chapter 3, Financial Health. And honestly, looking at the Q2 fiscal 2026 report, it's a bit ugly.
Ugly might be polite. If you're looking at the income statement in isolation, without any context, it's a disaster. Revenue for the quarter was just $9.9 million. That is down 26.5% compared to the same period last year.
That's a quarter of their business that just vanished. That is the EV winter we talked about, right there in the numbers.
It's the direct impact of that inventory correction in the automotive space. But what really hurts isn't just the drop on the top line, it's the margin compression. Their gross margin fell from over 45% all the way down to 29.8%.
Ouch. That is a massive drop in profitability. Why did the margins crash so hard? What happened there?
It's a textbook example of a concept called negative operating leverage.
Okay, can you break that down for us?
Sure. Imagine you run a lemonade stand. It costs you $10 a day to rent the stand itself. That's your fixed cost. The lemons and sugar cost you 10 cents a cup. That's your variable cost.
Okay, with you so fair.
If you sell 100 cups for $1 each, that $10 rent is spread out over a lot of sales. It's only 10 cents per cup. You make a huge profit on each one. But what happens if you only sell 10 cups one day? That $10 rent now means you're paying $1 per cup just for the stand before you even buy the lemons. You lose money on every single sale.
So Aehr has the factory, the engineers, the lights, the R&D. Those are their fixed costs, their rent.
Exactly. When their sales volume dropped off a cliff, those fixed costs started to eat up a much larger percentage of every dollar they brought in. On top of that, the product mix shifted. They sold fewer of their super high-margin wafer packs and more of the lower-margin systems.
And this combination pushed them into the red.
Yes. They swung from a profit to a GAAP net loss of $3.2 million for the quarter. So right now, as we speak, the company fails the fundamental value investing test of consistent earning power. They are losing money.
But we have to go back to the balance sheet again. We mentioned the cash, but what about the burn rate? How long can they survive losing over $3 million a quarter?
That is the saving grace here. Their actual cash burn from operations is much lower than the net loss figure suggests. They only used about $1.5 million in cash from operating activities over the last 6 months. With $31 million in the bank, they have years and years of runway.
So bankruptcy is not a real risk here.
It's a minimal risk. This is an asset-light business model. They assemble systems. They don't own massive billion-dollar fabrication plants like Intel or TSMC, so they can survive a drought. They can essentially hibernate if they have to, which is a huge advantage.
Okay, let's get to the part everyone waits for, the valuation. We've run the numbers through a discounted cash flow analysis, a DCF model.
The gold standard of valuation, at least in theory.
This is where we try to figure out what the company is actually worth based on all the cash it's expected to generate in the future. Because ultimately, a stock is just a claim on those future cash flows.
Right. And to do this, we have to make some pretty significant assumptions about the future. First, we're assuming that fiscal 2026 is the bottom. We're modeling revenue for the full year of about $48 million.
Which is pretty low, reflecting the current slump.
It's the trough. But then for fiscal 2027, we're modeling a very robust recovery, 50% growth, up to $72 million, driven entirely by that new hyperscaler AI ramp. And after that, we're assuming 35% growth for a couple of years, then tapering off.
Those are pretty optimistic growth numbers.
They are. We are absolutely giving them the benefit of the doubt on the AI story. We are assuming the pivot works perfectly. But here's the most crucial lever in the whole model: the discount rate.
The discount rate, this is basically the interest rate we use to calculate the present value of all that future money. Because $1 in 2030 is worth less than $1 in your hand today.
Exactly. And we are using a 10% discount rate.
Why 10%? I saw some other analyst models using a rate closer to 7%.
A standard WACC, weighted average cost of capital, might be around 7.33% for a stable, large-cap tech company. But Aehr is a small-cap stock. It's highly volatile. It has extreme customer concentration risk. A conservative investor, a Buffett-style investor, demands a higher rate of return to compensate for taking on all that extra risk.
So we use 10% to build in our own margin of safety? We're being picky on purpose?
We're imprudent. So when you crank all those numbers and assumptions through the machine, what is the magic number? What's the output?
The intrinsic value calculation comes out to approximately $25.36 per share.
Okay, $25.36. Now, the big question: where is the stock trading today?
As of January 31st, 2026, it was trading around $26.88.
So it's trading at a premium to our calculated intrinsic value. You are paying $26.88 for something that, by our conservative math, is worth $25.36.
So there is no discount.
There is no margin of safety. You know, in value investing, the goal is to buy $1 for 50 cents. Here, you're essentially buying $1 for $1.06.
Which means the market is already pricing in that the AI pivot works perfectly and without any delays.
Exactly. All of the good news is already reflected in the current stock price. If there are any delays, any hiccups, any missed orders, the stock has significant room to fall just to get back to a more rational valuation.
That is a tough pill to swallow if you really love the technology and the story.
It's the classic struggle for an investor. A great story, but an expensive stock. Part 2, Chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion.
Chapter 4. Market says,
Welcome back to part 2. We've crunched the hard numbers, we've looked at the balance sheet, and we've analyzed the physics of the technology. Now we need to look at something much squishier, but arguably just as important, the psychology.
market sentiment, the mood of the crowd.
Exactly. Because in the short term, as the saying goes, the market is a voting machine, even if it's a weighing machine in the long run. And right now, Aehr Test Systems is a total narrative battleground.
It really is a tale of two completely different narratives. It's like investors are watching two different movies at the same time.
Okay, let's start with the bears. What is the movie they're watching? What's their story?
The bear case is titled The Endless Winter. Their argument is simple, and it's grounded in the data we just discussed in part 1. They say, look, the EV winter is real and it's not going away anytime soon. They look at that 27% revenue drop and say, the primary growth engine for this company, silicon carbide for cars, is effectively broken or at least paused indefinitely.
They see a company that is currently losing money.
Right. They see a company that is burning cash, losing money, and trading on nothing but hope and a press release. They think the AI pivot is just a convenient distraction from the fact that their core business completely collapsed.
Okay, that is a pretty depressing movie. What are the bulls watching?
The bull case is called the AI gold rush.
Much catchier title.
The bulls argue that the EV drop is just a blip. It's a temporary speed bump. They see Aehr as a classic pick-and-shovel play for the massive data center build-out that's happening globally. They argue that just as reliability was essential for EVs, heat dissipation is the absolute #1 bottleneck for scaling AI.
And they believe Aehr has the only real solution that works for these new high-power chips.
Correct. And based on recent events, the market seems to be buying tickets to the bull movie lately.
Why do you say that? What's the proof?
The proof is in the price action. Despite that awful earnings report we discussed, the revenue drop, the margin crush, the net loss, the stock actually spiked 40% after it was released.
That makes absolutely no sense. Bad news comes out and the stock goes up.
It's a crystal clear signal that the market is looking through the current bad numbers. Investors are pricing in the future AI story. They're buying the forecast from the CEO, not the trailing 12 months of results. They are effectively saying, we don't care about Q2, we only care about 2027 and beyond.
That takes a lot of faith. What is Wall Street saying? The professional analysts.
They are pretty divided, which is typical for a pivot story like this. The average analyst price target is currently $24.33.
Wait, hold on a second. The stock is trading at $26.88.
Yes.
But the average analyst target is $24.33.
Yes, that's right. The average target is lower than the current price.
That is extremely rare. Usually the price targets are way above the current price to entice people to buy.
It suggests that the stock price has run ahead of the fundamentals, likely driven by retail investor excitement. We even saw a notable downgrade from the firm Craig-Hallum, who cut their rating to hold. They basically said, we like the story, we believe in the tech, but the valuation has just gotten too high, too fast.
And technically, if we look at the charts, what do they tell us?
The momentum is very, very strong. The Relative Strength Index, or RSI, is approaching overbought territory. That's a technical indicator that usually means the rubber band has stretched too far and is due for a snapback. The stock needs to consolidate and breathe for a bit.
We also have to mention the short interest. There are a lot of people betting heavily against this company.
Yes, and that creates a highly sensitive, highly volatile situation. The short interest is high. If that promised $60–80 million in bookings doesn't materialize in the second half of the year, the shorts will be vindicated and they will pile on. The stock could crash hard.
But
right.
There's always another side to that coin.
But on the flip side, what if Aehr comes out and finally announces the name of that lead hyperscaler? Or if they drop another big unexpected order in a press release,
To get a massive short squeeze.
boom, the shorts would be forced to rush to cover their positions, which means they have to buy back the stock, and that buying pressure would drive the price even higher, even faster. It's a powder keg. It could explode in either direction depending on the next piece of news.
Chapter 5. Ownership structure.
Let's talk about the passengers on this ship. Who actually owns Aehr Test Systems? Because knowing who you are investing alongside is just as important as knowing what you're investing in.
It's a fascinating mix, actually. It's a combination of incredibly steady, long-term hands and some absolute wild cards.
Okay, let's start with the steady hands. The institutions.
Institutional investors like mutual funds and hedge funds hold about 70% of the float. That's a very high number for a small cap company like this.
Is that a good thing or a bad thing?
It's generally a good thing. It shows that the smart money has done their due diligence and they see long-term value. But it's also a double-edged sword. It provides stability, but if a major institution decides to exit, say because they lose faith in the pivot story, they can crush the stock price because there aren't enough buyers in the market to absorb millions of shares at once.
One name popped out in the ownership report that I recognized immediately: Bailey Gifford.
Ah, yes. They own about 4.2% of the company.
Why is that name so significant in the investment world?
Bailey Gifford is legendary in the growth investing community. These are the people who made massive early bets on Tesla when everyone thought Elon Musk was crazy. They were very early investors in Amazon. They were early in Moderna.
So they're moonshot investors. They're looking for the next big thing.
Exactly. They look for companies that they believe can go up 10x or even 100x over a decade. They don't care about a bad quarter or two. They care about the 10-year horizon.
So their presence is a huge vote of confidence in the technology itself.
Absolutely. It says, we believe this technology has the potential to be truly disruptive and change the industry. They validate the core technology thesis. They are willing to tolerate this extreme volatility because they are chasing massive multi-bagger returns.
But then there's the other group of owners. They're retail cults.
Yes, the internet army. If you go on Reddit or StockTwits, Aehr has a very, very active and passionate retail following.
What's the narrative in those communities?
They view Aehr as a mini NVIDIA. They see the AI connection, they see the small market cap, and they get very, very excited. They dream of turning a small investment into a life-changing fortune.
Which probably explains a lot of the volatility we were just talking about.
It does. Retail investors tend to be more emotional. They react very quickly to news headlines. They panic sell when the stock drops. They have FOMO and buy when it rises. This adds to the stock's beta, its natural tendency to swing more wildly than the overall market. So if you decide to buy this stock, you have to be prepared for a very bumpy ride. You're sharing the car with some pretty erratic drivers. Chapter 6, Risk Assessment.
We've touched on risks throughout the show, but I want to formalize it here. Chapter 6, Risk Assessment. We always like to run through a quick SWOT analysis: strengths, weaknesses, opportunities, and threats.
Okay, let's do it. Strength. What's the number one strength?
It has to be their unique technology. The active thermal control for high-power chips is real, it's patented, and it solves a fundamental physics problem that traditional air cooling cannot solve. That is a hard, defensible tech advantage.
Weakness.
Customer concentration. This is the big one. They used to be dangerously dependent on CV for their EV business. Now they're transitioning to being dangerously dependent on this one mystery hyperscaler. If that single customer sneezes, Aehr catches a deadly cold. If that customer delays an order by a single quarter, Aehr misses its guidance and the stock gets hammered.
Opportunity.
We haven't talked about this much, but a huge future opportunity is silicon photonics.
What is that exactly?
It's the next generation of data transmission technology. It's about using light instead of electricity to move data between chips and servers. The upcoming 5G and 6G networks will rely heavily on this, and those photonic chips are incredibly sensitive to heat and defects, and they need 100% burn-in too. That's a whole new future growth lever beyond just AI processors.
And finally, threat.
Competition. Aehr is a very small fish in a very big pond. You have companies like Teradyne that are $15 billion giants. Currently, Teradyne doesn't have a liquid-cooled burn-in solution that can match what Aehr offers. But they have virtually unlimited money. They have thousands of engineers. If this market becomes big enough, Teradyne could decide to develop a competing product and try to crush them. Or they could just buy a competitor to attack Aehr's niche.
Now we have to talk about the macro risks. The stuff that's completely outside the company's control. Specifically, the government is getting much more involved. Let's talk about tariffs.
Right. On January 15th, 2026, the U.S. government slapped a new 25% tariff on a range of semiconductor manufacturing equipment.
This is a complex one, because usually you hear tariffs and you think it's bad for business, right?
Usually. But this situation actually has both a bullish angle and a bearish angle for Aehr. It's not clear-cut.
Okay, let's hear the bullish one first. Give me the good news.
The good news is that Aehr manufactures its systems in Fremont, California. They're a U.S. company building products in the U.S.
What's the implication?
So if a U.S. customer like Microsoft or Amazon buys a system from Aehr, they pay 0 tariffs. But if they tried to buy a similar system from a competitor manufacturing in Japan or Europe, they might get hit with that 25% tariff cost. That gives Aehr a massive pricing advantage in its home market. It effectively makes their machines 25% cheaper relative to foreign
That
rivals.
sounds great. What's the catch? What's the bearish angle?
The supply chain. Aehr assembles the final machine in the US, but where do all the individual parts come from? The power supplies, the specialized chucks, the computer chips that go inside the machine?
Probably from all over Asia.
Exactly. A lot of that comes from complex global supply chains. If their component costs go up by 25% because of tariffs on parts imported from China, for example, then their own margins, which are already suffering, as we discussed, get squeezed even further. We don't know the net impact yet, but it introduces a lot of cost uncertainty.
And finally, there are the new export controls,
Mhm.
the rules that came out on January 13, 2026.
This is what I call the China ceiling. The Bureau of Industry and Security tightened the rules significantly. Effectively, you cannot export advanced burn-in systems for high-performance AI chips to China anymore. There's a presumption of denial.
So that entire massive Chinese market is just off limits?
Effectively, yes. Aehr cannot sell their latest and greatest systems to companies like Huawei or HiSilicon. This puts a hard cap on their total addressable market, or TAM. They are limited to the Western supply chain and its allies. It prevents them from tapping into what is likely half of the world's long-term demand for AI chip manufacturing. It puts a rigid ceiling on how big they can ultimately grow.
Chapter 7. Conclusion.
We've unpacked the physics, the financials, and the fears. We've looked at the high-tech ovens that are designed to keep the internet from melting down. Now, let's bring it all home. Chapter 7. Conclusion.
Let's go back to our simple value investors checklist. We ask 4 basic questions before we would ever consider buying a stock.
Hit me. Let's run through it.
First, is the business simple to understand?
Yes, I think so. It's basically industrial ovens with brains. It stress tests chips so they don't break in the field. I get it.
Second, does it have a consistent, stable operating history?
No, absolutely not. It is boom and bust. It's the definition of extreme cyclicality. We just saw that with the EV winter.
Third, does it have favorable, long-term prospects?
Yes, without a doubt. The trends of electrification and AI are unstoppable. The world is going to need more powerful chips, and those chips are going to need to be reliable.
And the fourth and most important question, is it available at a rational price?
And that, right there, is the sticking point.
It is. The answer today is no. At nearly $27 a share, the price assumes perfect execution. It assumes the CEO's aggressive guidance is 100% accurate. It assumes there will be no delays, no competition, and no macro shocks.
So what is the final verdict? Buy, sell, or hold?
Verdict is a H-hole.
Not a sell, but definitely not a buy either.
Exactly. It is not a buy for a conservative, value-oriented investor right now. There is simply too much optimism baked into the current price. However, if you already own it, maybe you bought it cheaper last year, the technology is too compelling and the potential upside is too great to sell. You don't want to miss the boat if they really do land another whale of a customer.
So if I'm an investor sitting on cash and I'm looking to get in, what's my number? When do I pull the trigger?
You're waiting for a pullback. Markets are volatile, especially for story stocks like this. If this stock were to drop into the $18 to $20 range, that becomes a much more attractive entry point.
Why that specific range?
Because at that price, you have a cushion. You have a margin of safety against execution risks or delays. That's the price range where our calculated intrinsic value starts to align with the market price. You're finally buying the dollar for 80 cents rather than for $1.06.
It is a classic case of a great company, or at least a company with great unique technology, not necessarily being a great stock to buy at this specific moment in time.
Precisely. The smart money is patient. They wait for the price to come to them. They don't chase the hype train after it's already left the station.
Well, there you have it, a company ensuring the brains of our AI future don't melt, all while navigating a minefield of tariffs, market cycles, and sky-high expectations. A fascinating look at the intrinsic value of reliability.
Always a pleasure to dig into the details.
Thank you for joining us on this deep dive into Aehr Test Systems. We hope this gave you some clarity on both the physics of the technology and the financials of the business.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.